Hello, everyone, and welcome back to another exclusive Boom Room interview. I am Sasha with Arcanum Ventures. I'm here with my good friend and colleague, Carmelo. And today we have the pleasure of welcoming Zack Shapiro, managing partner at Rains Law and head of policy at the Bitcoin Policy Institute. Zack, it's been a little while. Thanks so much for coming on. How are you doing?
Thanks so much for having me again. It's going well. We were just talking before the recording. Very busy as always, but always interesting times.
Yeah, we know that you work a lot within the world of Web3 and blockchain, and it's ironic being this busy this time of year in December because usually the entire industry, like many others, just like exits and checks out for December, right?
Yeah, on the
Well,
one hand, that's true. On the other hand, in sort of the for-profit side of the world, there's the end of the fiscal year, and then with my policy work, the end of the year is also its own sort of deadline before people start thinking about the midterms in 2026. And so
oh yeah.
there is, ironically, it can get extra busy leading up into the holidays.
Yeah. Well, I can't wait to talk all about that with you and Mello. But before we begin, we're going to start this interview in the same exact boring manner we start every interview here in the Boom Room, and that is with an introductory question. So please, Zach, give us an idea of your education, your background, your foray into crypto. How did you find yourself working within the world of legal in the cryptocurrency industry, and how do you find yourself to be here speaking with us today?
Yeah, it's. I think I have a bit of an unusual path into the crypto space. I grew up outside of Washington D.C. My parents are both lawyers. They were sort of more traditional careers. My dad worked in the government for a long time, and I didn't have any kind of cypherpunk like upbringing. I went to Williams College for undergrad in Massachusetts, small liberal arts school, where I studied philosophy and psychology. Spent a year at Oxford, and then I went to Yale Law School where I graduated in 2016. When I went to law school, I figured I wanted to be essentially sort of a philosophy professor. I was really interested in sort of the intersection of philosophy and law and really sort of esoteric academic subject matter and not so much the practical. By the time I left law school, I had a couple sort of great mentors, chiefly among them this professor named Amy Chua, who's famous for coining the term "tiger mom." If you've ever heard that, that's a book about her parenting her children, and she has this great sort of network of alumni students, and was like, "Look, um, the jobs people really care about coming out of elite law schools like Yale are working for federal judges called clerkships, working in the government, being a federal prosecutor." Maybe being a partner in a big law firm. But the people I know who are happiest out of law school tend to be the people working in tech and business, because it's one thing to be sort of an elite lawyer where everyone around you is an elite lawyer. It's another thing to sort of have this credential and be the only person in that area. So that was sort of in the back of my mind. Now I had signed up for these clerkships working in the federal courts for my first and third year out of law school. By that point, I wasn't quite sure I wanted to practice law, and I was looking for in between those clerkships, those 1 year stints in the federal courts, something sort of more entrepreneurial, maybe more tech focused to do. So I interviewed for a couple jobs as chief of staff at tech companies, that type of thing, but no one wanted to hire me for 1 year with no business experience, where I was unwilling to give up the second clerkship, and so I ended up at a big international law firm called Davis Polk. I don't know, how much your audience will know about working in big law firms. It pays really well, but it's famously sort of a boring and very difficult job. And so I was looking for a way to make that more interesting. A friend of mine was starting up a very early crypto hedge fund at the time. So this was early 2017. And asked me what were at the time really interesting, novel legal questions about crypto. And so I figured, this might be an angle. So when I got to Davis Polk, I raised my hand and said, listen, I know this isn't a thing the big firms are doing right now, but if you happen to get any crypto work, like I'd love to be one of the guys doing that. And as your listeners probably do know, I happened to get the timing on that spectacularly right, and I was there through the ICO boom, and I got to work on some of the really big token launches. I helped develop some of the sort of first theories on like what would it mean to insider trade on Bitcoin? Was there such a thing? Because there are no insiders. By the way, at the time, right, the narrative around Bitcoin was much more focused on medium of exchange than store of value. So the most bullish thing we could think of is like, what if Amazon started accepting Bitcoin for payments? Not realizing that no one would, because of capital gains, want to pay Bitcoin for anything. So that was a cool experience. But at the time, at least with this sort of institutional crowd, the narrative was very much blockchain, not Bitcoin. And so I came away from that experience being like, this technology is cool. There's some really interesting legal questions about what's happening on the dark web. But I don't know which one of these coins is going to be worth anything. And I watched it all crash heavily in 2018, and I kind of stepped away from it. Um, when I finished up my second clerkship in the Second Circuit, which is the federal appeals court in New York, I was really looking to step away from the practice of law and see if I could like be a startup founder. So I joined a friend who was doing a e-commerce startup, and sort of the deal they gave me was I could be an operational co-founder. I would also have the general counsel title, and I would do legal work to sort of earn my keep while I transitioned over to the ops side. That was a great experience for me. It was like a mini MBA. We raised money from some great VCs, Founders Fund, Abstract, Graycroft. The company got sold in 2020. And I learned the exact opposite lesson that I thought I would, that I do not want to be an operational co-founder. It's too hard. It's not how I want to spend my time, but I love being a startup lawyer. I really, it's so different than being in a big law firm. You're really at the intersection of business questions and legal questions. You get to make decisions. It's much more about sort of like supporting people's business objectives than it is getting every single thing. Like, representing a Fortune 500 company is just a completely different calculus, right? You have to be incredibly conservative, incredibly buttoned up. And, someone once described to me, being a startup lawyer it's like being sort of a bouncer at a strip club. Your job is to make sure the real police don't show up. And there was a part of that really appealed to me. So when the company sold in 2020, I was thinking about what I was going to do next. I did some sort of like freelance legal consulting for some of the founders that I met in that role. And that ended up going better than expected and snowballed into what became a full-time solo practice, and then eventually evolved into the law firm I have now, Reigns, where, I get to support founders who are building cool stuff. And then the last piece of how, I got into the crypto world was in the pandemic. So 2020, 2021, I got into Clubhouse. I figured this would be a way. I was just starting a law firm, and I could meet founders. I could sort of learn different subject matters. The startup I was at was e-commerce, and I was still interested in crypto tech, even though I wasn't a believer. And so I sort of used Clubhouse in the big, I didn't realize it was specific to Bitcoin, but I thought crypto community at the time on Clubhouse to be like, all right, who are the smart people? What are the interesting ideas? And that time it really did stick, and I fell down the rabbit hole and was more or less convinced by the Bitcoin maximalists were the people in the room who knew what they were talking about. And so, that became a big part of my network. And it's, at this point, I would say that like crypto and Bitcoin is probably 80+% of my client base, and a real thing that I specialize in.
It's really funny you say that because I think after our last conversation in New York a few years back, I was like, damn, I want to be a crypto lawyer. Like, I really considered going to law school, and then I saw how much work it was. But Sasha and I have met a lot of legal professionals in the space that are like not very good at their jobs, or they completely abstracted away every part of their job to AI or whatever, and they charge a lot of money basically for like an opinion letter. But after speaking with you, we're like, wow, this the space needs better lawyers and more of them. But I wanted to ask, like back in 2017, were there any other lawyers focused on this, or was it like you were pretty much one of the only ones back then? Yeah.
Yeah, I mean, there have always been two types of crypto lawyers, broadly speaking. There's the big firm lawyers that, they represent whoever, and those include whoever has a lot of money in crypto at the time, and that's where I was. Right, I was in a big firm. I wasn't a true believer. I was, someone who was there to do interesting work for big clients.
Hmm.
And then there are the sort of crypto native lawyers, and there absolutely were some crypto native lawyers in 2017. Several of them are now friends of mine. It's a very small community of people who are like good lawyers and really into crypto. But it was just a handful. And like I put it this way, like the people who were crypto native lawyers in 2017, they all know each other now. It's that size community, right?
Yeah,
Yeah.
it's such an interesting journey. Well, first of all, I wanted to say you said you went to Yale, so shout out Connecticut. Carmelo and I are both Connecticut boys, and people don't believe me when I tell them the best pizza in the country is in
Yeah, it's
Connecticut.
pretty good. The clam pizza.
Oh my
Oh yeah.
goodness. And yeah, it's like them's fighting words. But like Mello mentioned, one of the reasons when we first connected, I think you and I were on a panel on X or Twitter, and I made a mental note of, wow, this person knows so many deep aspects about this industry, but they're a legal professional, and we don't meet many legal professionals that know the ins and outs when it comes to DeFi, self custody, privacy, speculative digital assets, all these different things. And it makes sense because you'd been there since the beginning, but maybe this journey of being more of like a founder first legal professional it was able to give you a lot of really interesting insight into, like you mentioned, the strategy behind business, how you make certain moves, and how it impacts the company from a regulation or legal compliance standpoint. But I did want to ask, on that journey specifically, like, does anything stand out in your mind that helped you learn some of these very deep and interesting aspects of crypto that many people don't know? Like for us, what comes to mind is, like, we talk about token economics all the time, and in designing token economies, we have to understand everything that's worked and hasn't worked in the past when it comes to similar types of economies, and then how that ties to, let's say, financial viability of the business, but maybe even marketing strategy.
Yeah, I think it's two things. One, there's a joke I hear a lot that, everyone in crypto is neurodivergent to some extent, right? It's either ADD or autism, but it's not neither. And I think the reason for that is that a lot of the interesting part of crypto is so complicated, in many cases so counterintuitive, right? Even just think about Bitcoin. It seems like a scam. It seems like it's backed by nothing. And to be able to penetrate through that, to understand how all of these intricate pieces work to make it the best form of money humans have ever created, it requires a type of hyperfixation that you're either going to do or you're not. And so the pool of people who, are able to get into the weeds in that, whether or not they're a lawyer, that's already a small pool. So you need to have been bitten by the bug. And like I mentioned, I didn't get bitten by the bug until 2020 or 2021, even though I was pretty deep on what the tech is half a decade earlier. The other thing is my experience being a startup co-founder. Like I find that even though it didn't leave me wanting to do it again, it was an incredibly useful experience in that I got to think about legal questions the way a business operator would. And I think aside from not being sufficiently crypto native, a big problem with a lot of lawyers, including lawyers who serve crypto companies, is they've never been in a business seat, right? They went to law school, they maybe worked in the government or maybe not. They worked in a large law firm, and when you're associated with a large law firm, you're not even exposed to the business side of the law firm. You're just doing tasks. And that does not make you, that makes you very good at minutia. That doesn't really make you good at seeing the big picture. And really core to my philosophy, and now core to my firm's philosophy, I try and basically only hire people who've had non-legal business roles because I think it's really important for their understanding, is that legal advice should be an input into business decision making, right? And it shouldn't be the tail wagging the dog. There is, as I mentioned before, some advice that's appropriate to give to a Fortune 500 company. There's some advice that's appropriate to give to a pre-seed startup. These things are not always the same. My job is not to tell you what to do. It's to give you all of the information you need to make the decision that you need to make, right, on a risk-adjusted basis. Of course, clients will often ask for my advice. What would you do in my shoes? And I'm always happy to give that advice. But, like, I am a resource to help you make good decisions. I'm not sort of the compliance department, right? Those are distinct roles.
Yeah, that's a great point. Like you don't necessarily want to put your neck out like that and tell them what to do because we had somebody on last week that was talking about security. So it's much the same. Like you can only advise so much, but it's up to them to make the choice. But it probably drives you nuts seeing people giving bad legal advice or compliance advice all the time. And I wanted to ask also, like, what is it like advising a small pre-seed startup in crypto versus a Fortune 500 company? Like, what are the main obvious differences and maybe some differences that people don't consider?
Well, I mean, there are lots of variables you just mentioned, right? There's crypto, there's pre-seed, right? Those are both
Yeah.
pretty distinct categories from a legal perspective.
Hmm.
I mean, one obvious difference, just based on size and based on crypto, is going to be risk tolerance, right? And I don't want to sort of like reinforce the stereotype that everyone out here is in crypto breaking the law. But like the truth is, if you want to launch a token, and that's a big part of crypto, it's very hard to do so with absolute assurance that you're following securities laws, right? Unless you're doing a absolutely pure meme coin, which has fallen out of favor because arguably those are toxic in their own way. Or a stable coin, but then you have to comply with the Genius Act. Like there's not a way to launch a token and be absolutely sure this is not going to be swallowed by this facts and circumstances analysis called the Howey test that makes it look like a lot of things that you'd issue on chain would be securities. And so when you're advising a client like that, like you do need to make them aware that like anyone who's telling you this is like perfectly good to go, they're lying to you, right? They either are a bad lawyer and they don't understand, or they're just like trying to sell opinion letters. That's why, I'm very frustrated with lawyers. I will occasionally do them, but they'll be sort of hedged and specific to the situation. There are people out there who are like opinion letter mills, and like that's,
Yeah.
I think it's pretty unethical. So you need to sort of make people aware of the risk. And then, back to this sort of intersection of business and law, like you can go wrong with your legal advice on both sides. So the lawyer that's like, you can't do this, all tokens are securities. Well, like that's not helpful, right? People are going to launch projects that have tokens. Advice, okay, hide in the Cayman Islands, and then it's all, like that also doesn't work, right? Like the jurisdiction for all of this stuff is, are U.S. individuals going to get access to the tokens? And so that's all bad advice and overly conservative. And then with the Cayman advice, it's just wrong. And then there are lawyers that are like YOLO, right? As long as you don't promise that you're going to get ownership in a business, and that's also wrong. And so like when you give good advice, it starts with, okay, here are the risks sort of inherent no matter what. Then here are the things, the knobs you can turn as a founder, right? This is something I'm sure not that different than you all talk to founders about. Here are the knobs you can turn to make something more or less legally safe. And this, it might be sometimes cross purposes with the sort of business purpose for the token. But the two things in my mind that you have control over that make a difference from securities law, just to use this example, one is tokenomics and the other is marketing materials. So with tokenomics, are you offering something that looks like dividends or protocol revenue? That makes it look more like a security because you expect to profit based on whoever's developing the protocol. Is there a limited or unlimited supply of tokens? I think way too many projects have a hard cap for their token just because that's what Bitcoin did. It was appropriate and necessary for Bitcoin. I don't think it's necessary and appropriate for every project. There are things that you need to be aware of about lockups, right? If you're going to sell the token, regardless of whether you think the token is ultimately going to be a security in a Howey test, when you sell tokens to private investors, you're almost always going to do that through a securities instrument, right? Like a SAFT or a token warrant. When you do that, how long do the tokens need to be locked up, right? There's some controversy around that. So there's like that side of things. And then there's the marketing materials, which are arguably more important, which is what do you say about the token? And I think most lawyers can tell you like the basics of what not to say, right? The don't talk about the price going up, don't talk about the work you're going to do to make the price go up, but then there is the more nuanced and I think really at least as important side that I don't see a lot of lawyers doing well enough, which is, okay, if this thing isn't going to be a security, what is it? And so the negative is fine. Don't talk about, the token mooning. What's the positive? What should you say? Right. And it can't be that you say nothing because like that doesn't make any sense and no one's going to buy the token and that's going to look suspicious too. You need a credible story depending on what your compliance strategy is. If you're going to say this is a utility token, you need to be marketing that token to people who are going to use it consumptively for the right. So to take like the most famous sort of utility token, right, Filecoin or something like that. If you're selling Filecoin, sell it to people who are going to use it for storage credits, right? Don't sell it to people who are going to speculate on it. And the more your marketing materials say that, and they don't say the market cap of this thing is going to go up, the less attractive target you are for an enforcement action. And so like a lot of time I spend working with clients on this question, it is not just here's a list of things you can't do, but let's come up with like why we think this is compliant. And then let's really lean into the design of the token if I can get involved early enough, or at the very least lean heavily into the marketing materials to help support this sort of legal story that we're telling.
Yeah, it's a great way to put it. Sasha and I, we got feedback on a white paper we helped craft like a few weeks ago, and it was mostly redacted. And the legal team, overly cautious, said you can't say anything about the token. It doesn't exist for all intents and purposes. So
Yeah,
that's a great.
It's not helpful.
Yeah, it's not helpful at all. And they're like, don't say medium of exchange, don't say this, don't say that. And then you're right. Like, what are we supposed to, you know, do we just say the quiet part out loud? Like, yeah, everybody wants to speculate on this token. Like, you have to say something about it.
Yeah. And that's where like a good lawyer is worth it and a bad lawyer is a really huge waste of money. One other thing I guess I'd say so that's like a regulatory question. Another area, so like another big part of my practice is venture deals. And in a lot of ways, like I like the Howey test. I think it's a fun puzzle. I really like venture deals. That's one of my favorite things that I get to do is help. I work with a couple of VC funds that I represent, but I really try and stay on the company side because I like helping negotiate for founders against VCs. And that is very different in crypto than it is in non-crypto. With normal startups, there's a progression from you use, early fundraising. You're going to use the Y Combinator SAFE simple agreement for future equity, which is a form document that basically nobody modifies. There are a couple of variables. You should talk to a lawyer about what you want, but a lawyer shouldn't be drafting a SAFE for you. You just download it from the Y Combinator website. And then later on, you do what's called a priced round where you're actually selling preferred equity in your startup. And there, unless if you have lawyers that they know what they're doing, they're also going to everyone uses the same set of document templates. They're called the NVCA or National Venture Capital Association documents for price rounds. And, there are things that you argue about back and forth, but it's kind of a limited universe of what the industry terms are. With crypto, it's quite different because even in early rounds, in addition to SAFE, you're doing a token warrant. And there are some terms that are kind of the industry standard for token warrants, but it's a much broader universe and it's much more quickly changing in terms of like what the market norm is. And so with an early stage venture deal, like if you're a founder, you can wrap your mind around valuation. And when you do a post-money SAFE, you're basically valuing the company. There's not going to be a lot of room for getting screwed one way or the other. As a early stage crypto founder, oh man, I have seen so many different token warrant side letters, like terms that, the plus side of being early stage crypto founder is you get a higher valuation on your company because there might be tokens. The downside is there's so many more variables to negotiate. And so there's like early stage crypto deals are much, much, much more complicated than early stage non-crypto deals.
It's such an interesting thing that you brought up because this is a side of it that we've also been helping a lot of founders in structuring around the fundraising side and tying in the digital asset offering into the value proposition. And it is a very loose landscape, right? These are very new things. And so we hear people talk about token warrants or token reward agreements or all of these different types of things. But they use them loosely, and they can mean many, many different things to the founders and the VCs. And we often see VCs structure their own type of like bespoke requirements when it comes to how tokens should be distributed, under what terms do they receive them, under what valuations against like the anticipated public listing price. But you working more specifically within guiding that and also making sure that this entire process is compliant, or at least as compliant as can be. What are some big red flags and green flags that you see in undergoing this practice?
Well, most of it and most of the red flags aren't about compliance. I mean, there is one that I think is sort of broadly misunderstood. So, a SAFE and a token warrant and a SAFT and anything that you might sell to an early stage VC or angel investors, whatever you think about your token, all of those things are securities, right? Like all of those instruments are securities. So they need to follow securities law. By default in the United States, securities offerings have to be registered with the SEC, which is the same as going public, and it's really onerous and expensive. And so there are all of these exemptions from having to register your offering with the SEC. And basically all private equity and venture capital, and this includes crypto, uses the same exemption, at least for domestic offerings, which is called Regulation D, or Reg D. And there are a couple of rules for Reg D, the sort of two most important of which are one, you must sell to accredited investors. That's something that probably a lot of people listening to this will know. But then the other is you can't sell to an underwriter. Now, what's an underwriter? An underwriter is someone who buys an asset with the purpose of reselling that asset in the future. And you might say, well, anybody buying a SAFE or a token warrant, whether they're a VC or an angel, of course they're going to resell it. Of course, that's why they're buying it. That's what all of venture capital is. And the SEC thought of that, and so there is a what's called a safe harbor. A safe harbor is if you do X thing, we will deem Y to be legally true, called Rule 144, that says if you hold a asset sold under Reg D for a year, we will not invalidate your Reg D exemption just because that person then resells later. The best understanding I think now among crypto lawyers is that means you need to have that Rule 144 safe harbor to be safe should apply both to the warrant, but then also to the underlying token. And so I think that from a compliance perspective, there is a best practice out there. I think this is a good way to figure out what projects have good lawyers versus don't. Do they have a 1 year enforced lockup post TGE? So I actually think that from a compliance perspective, I can make the other side of the argument, but I think the safer thing to do is to do that. Most of the other red flags are not compliance related. They're VCs trying to screw you. I can't talk about that many specific instances I've worked on, but there's been one that got a lot of recent attention on Twitter. I don't know if you saw, Unchained broke a story about Barachain, and there was a side letter where a Brevin Howard subsidiary had a right to be refunded essentially their entire venture investment. That's crazy, right? Like, it's not that it's illegal. Yeah, I mean, like, I saw Gabe Shapiro, no relation, another great crypto lawyer. He was someone who was here early. Suggested that maybe that was like fraudulent because it was a material thing that they should have told their other investors and didn't. Maybe not. But regardless of whether it's illegal to do that, that sucks. Like, that term sucks. And so, like, you gotta, like, you need to have someone, a lawyer who's experienced, to be able to spot these terms and be like, no, don't take that. The thing I end up negotiating the most in crypto deals specifically really is just around this. There's one term in a token warrant. It's the most important term. It's called the portion, and that's how much the investor gets out of the token supply. And especially for a capped supply token, like, this is really high stakes. The industry standard until recently was that insiders, meaning the team and VCs, get at least 50% of the tokens. That creates a giant overhang that's going to doom your project. Like, let's say, like, really, you have people aren't investing in your token. Okay, it's just a utility token. Query how much that actually happens, but let's assume in good faith. Nobody's going to buy your utility token if it's down only, because every time there's a token unlock, there are people with zero cost basis dumping the token. Like, that's not going to work for any kind of token, right? Much less an asset token. But even for a utility token, nobody's going to buy a token and store value even temporarily if they want to use your protocol, if the token is in down only mode. And so the more you promise to VCs, and this is hard because, right, you're early stage startup, you got to raise money. VCs are really breathing down your neck. They'll often tell you, listen, I've been doing this forever. I've in my 150 deals I've ever seen as a GP, like, everyone says yes to this, and I don't know why like, that's all bullshit. They are trying to extractively, in many cases, get as much of the token supply as they can. And look, and this is not all VCs. There are some good, but crypto VCs in particular, like, I see a lot of really sharky terms and people trying to take advantage of, especially first-time founders. And so this is part of why I love early stage deal work, is that I get to come in and be like, actually, Mr. VC, I too have done 150 plus crypto venture deals, and you're full of shit. And here are the market terms, and, like, this is going to make the token fail. But as an early stage founder, like, that is really important to, know when you're getting screwed. And I worry now, there's if you want, we can talk about sort of like the intersection of legal and AI, but a lot of people are starting to think that they can self-serve with, ChatGPT instead of a lawyer. And, the truth is, maybe in some cases, for some low stakes things, that's true. And I use LLMs all day, every day. Like, I find it incredibly useful in my legal practice. But man, if like, you have one side, which is an experienced, VC with experienced lawyers, and the other side is someone thinking that they're being well represented by ChatGPT, you're going to get your lunch eaten every day of the week.
Oh man. Yeah, I mean, I think ChatGPT would be far more agreeable than you on the other end of that table. So I'm
Yeah.
really happy to hear that. But yeah, it's interesting because, working within the world of token economics, we've always had this I don't know if pet peeve is the right term, but this kind of apprehension when you talk about like a utility token, it's tied to products, it's tied to the usage of products, features and services, but at the same time, it's being used to facilitate some fundraise. Like these should be segmented in a perfect world, but in the world of crypto, they're kind of not, right? And so that's where like token economics, protocol design, and what you do kind of steps in there. It's like how do we form some checks and balances to try and make this work for the company while the VC can also take their own share. But this is kind of like why I wanted to bring you on, and why Mello wanted to bring you on as well. We met talking about a lot of this stuff a couple of years back, and we realized that you know so much when it comes to the world of compliance and legal regulation within this industry. I did want to ask, taking this conversation more down that road, we've seen a lot sort of evolve in the last few years when it comes to crypto regulation in the United States. And I think that's been accelerated with incoming the new administration. And there's a lot of confusion. It seems. I think CoffeeZilla famously called it crime season. We're seeing like failure to prosecute blatant financial crimes. We're seeing a lot of people that are operating in that gray area. When you're talking about Reg D, for example, like I think a lot of startups would maybe fail that qualification. But I want to ask you, from your opinion, being involved in this space and potentially even working with lawmakers, like what do you see happening in the next few years when it comes to crypto regulation, especially while this administration is still in office? Do you think it's going to become more loose? Do you think they're going to catch up when it comes to the rules they've written down on paper, or is there some other outcome?
We'll see. I mean, I think it's important to separate out regulation and legislation here. So regulation is done by the administrative agencies, which are in the executive branch of the government. We have three branches of the federal government in the United States. We have the executive branch, which reports to the president. Their job is to execute the laws. We have the legislative branch, that's Congress and the Senate. Their job is to make the laws. We have the judicial branch, which their job is to interpret the laws when there's a dispute. The executive branch changes out every time there's a new president. And this president believes in really strong top-down authority. Policy comes from the White House, not from the agencies in an independent way. And they've been incredibly, at least in terms of vibes, incredibly pro-crypto. And so, we've seen, I think, a lot of good stuff. My favorite things we've seen in terms of executive policy is the executive order establishing the strategic Bitcoin reserve. I think that's really important for the sort of long-term viability of the country's balance sheet. We've seen the Blanche memo out of the Department of Justice saying that we are not going to prosecute software developers, just because of people using their non-custodial tools to commit crime. I think that's that statement is really important. Now, there's an interesting question whether they're actually following that statement, given that they let the Tornado Cash and Samurai Wallet prosecutions go forward. And then there's been a real pivot from enforcement actions going after otherwise good actors for violating the Howey test by doing token launches to genuine bad actors, right? I actually think there has been a good amount of enforcement against people committing real fraud, especially people committing these pig butchering schemes out of Southeast Asia that have, just unbelievable havoc on especially elderly Americans is terrible. And I'm really glad to see the government going more strongly after them. And then you see the SEC turning around from basically trying to snuff out crypto in the United States by using a unworkably broad interpretation of the Howey test to say that everything is a securities offering, to providing guidance of here's where we think the line is, at least in some cases. I wish they would go farther than they have. I think they will go somewhat farther. But I think that story is broadly optimistic. And I expect that to continue to be sort of good for the industry. The problem is it's temporary, right? If we get a different administration that feels differently, that can all go away overnight. There's not a lot of permanence to that stuff. On the legislative side, which is more permanent, now it's slower to do, it's also slower to get rid of. We've had one, I think, pretty good win, which is the passage into law of the Genius Act, which creates a regulatory framework for stablecoins. Now, it's not perfect, right? The bank lobby succeeded in killing the ability to do yield on stablecoins, at least sort of yield in a straightforward way. But that, I think, is important for sort of adoption of stablecoins, which I think is good for adoption of blockchains more broadly. And then there is another law that I'm very much hoping will pass. Although, a gun to my head, I think it's like 50-50, which is a market structure bill called the Clarity Act, which goes way farther in addressing at least the first parts of the like Howey test securities law problem. It provides a legal pathway to launch a token that is workable and that a future SEC couldn't just erase. And then, at least to me, more importantly, it also has more robust protections for software developers who are building non-custodial tools. We've talked a bit so far about the most famous regulatory problem in crypto, which is what is or is not a security, and that is a mess. And I hope the market structure bill changes that to some extent. But the other big question is, where is the legal regulatory line between a regulated financial institution like a bank that's subject to the Bank Secrecy Act and has to KYC and AML and all that stuff, and just a tool, right? So when you when you log into your bank website to do banking, right, your bank is regulated under the Bank Secrecy Act. They have to make sure they know who you are, and you have to show them ID. And fine, we can argue about whether the Bank Secrecy Act is a good idea in 2025. I think it's an interesting argument, but it's not going anywhere practically. But when you log into your bank through your laptop, let's say you're using a MacBook, Apple doesn't need to KYC you, right? That's just a tool you're using. The cables that connect your router to your Wi-Fi, they don't need to KYC you. It's just a tool. And there's a challenge in crypto where there are things that are functionally just tools, right? I mean, the whole idea of crypto is that it's a peer-to-peer system. That's the difference between Bitcoin and all the stuff that tried to be peer-to-peer cash or internet cash before, is that with the sort of Nakamoto consensus and with proof of work, Satoshi Nakamoto invented a way where before, if you wanted to transfer money electronically, including the other sort of like DigiCash, Eagle, the sort of pre-Bitcoin attempts, there was an intermediary. There was a company that was the clearinghouse for transactions. So it's you, then an intermediary, and someone else. If I send you money on Venmo, it feels like it's going from my phone to your phone, but actually it's going from my phone to my bank to an intermediary bank to an intermediary bank to your phone several weeks later. And all of those banks are regulated institutions. Not so with the blockchain. The whole idea of the blockchain is we all maintain the ledger. And so it's not me and an intermediary and you, it's just me and you, and we're using software in between us. And that gets even more complicated with sort of non-Bitcoin L1s that have smart contracts and DEXs and automatic market makers. And these things really do perform some of the functions that financial intermediaries used to, but they're not intermediaries. They are just software. And the current law has a really difficult time of parsing that. And federal judges, who tend to be very old, have a really hard time parsing that, right? We talked about what it takes to go deep on this technology. I promise you, like life tenure 80-year-old federal judges are not going deep on this technology. And so that's just a disaster waiting to happen. And so one of the reasons I really care about the market structure bill is it provides a specific fix to that question, right? It takes it out of the hands of people who do not understand this. And it's like, look, the line that we have is the only line here that makes sense, which is if you're in custody or control of other people's funds, then you're a money transmitter. The Bank Secrecy Act says you're a money transmitter if you accept and then receive value on behalf of other people. That's a custodial business model. If you're non-custodial, you're not a financial intermediary. That seems like the right line, and that's what the market structure bill would enshrine into law. That is, mostly the advice I still give clients, right? I mean, like I think that is what the law is now, but we've seen in 2 federal criminal prosecutions, Tornado Cash and the Samurai Wallet cases, the DOJ basically ignoring that distinction and trying to jail software developers who never had custody or control of people's funds. And that's a really dangerous precedent if that were to spread beyond these 2 situations.
There's a lot to unpackage there. Real quick, you said something earlier that really was interesting about insider trading, and if it was possible with Bitcoin. Do you think there is a case to be made about insider trading for Bitcoin and other digital assets, especially in light of, the president launching meme coins and stuff like that? And also we have ETFs, we have DATs, we have all these mechanisms where traditional finance or big entities can now collude and drop these prices, much like they can with traditional assets. But now, it kind of hides behind its decentralization. Like Bitcoin's decentralized; it's a ledger that everybody runs. But mining syndicates and people like Strategy has outsized ability to influence that, basically. Do you have any opinion on that, or if there's
Yeah,
like
I
a
mean,
case to be made?
that's a pretty easy one. I mean, the answer is yes. There you can insider trade in commodities and securities, right? Most
Yeah.
crypto tokens are either commodities or securities, and so you can insider trade on them, and it's illegal. And then there's a separate thing that I think you're referencing, which is not insider trading, but market manipulation, which is
Yeah.
extra illegal, regardless of the asset. And so, yeah, these are all crimes. It happens a lot, especially with DATs. Like,
Hmm.
look at all the big DAT announcements. You can see on the chart, it got front run. Someone in the
Yeah.
company, in the accountancy, in the investment bank, in the probably not the law firm, because lawyers tend to be a little bit more cautious about this stuff, but maybe in the law leaked that and insider traded on it, and like you absolutely can go to jail for that.
More so, you're absolutely right. But more so, like, let's take Bitcoin for example. Like, it's decentralized. It's not a company, but you can manipulate those markets. You can't really inside trade because it's not a company that's you're not working
No,
for it.
you
Nobody's
can.
working
It's a
for it.
commodity, and you absolutely can insider trade commodities. Now, there isn't necessarily insider information about
Hmm.
Bitcoin the company
Yeah.
because there is no Bitcoin the company.
Yeah.
But if you, let's say you're at MicroStrategy, right,
Hmm.
and you know that MicroStrategy is about to pivot and dump all of their Bitcoin, and you know what that's going to do to the Bitcoin price, and then you take a giant leverage short on Bitcoin, my view is that would pretty clearly be illegal, even though you have insider information about MicroStrategy, not Bitcoin, but that is insider trading in the commodities market.
Interesting.
I've
And
been seeing so
oh, go
much of
ahead.
that lately. No, I was just saying, like that's just like an everyday occurrence now.
Yeah, I was going to
Well, I
ask
mean,
if
so
there
is
is.
market manipulation, right? Like, you guys have seen there are just a bazillion Telegram chats, which are we're doing a pump and dump room, right?
Mm.
Yeah.
That's just market manipulation, right? Like that is historically a famous crime.
Yeah, I wanted to take the conversation back to a second. Something that you mentioned around these tools, right? I think there's been a lot of drama on X or Twitter a couple weeks ago, specifically around Uniswap. And I think I think it's Amanda Fisher, a former SEC staffer, that was getting into it with Hayden Adams, I think,
Mm-hmm.
who is the one of the founders of Uniswap, and so there was a lot of discussion about, like, the SEC trying to prosecute Uniswap for what it was doing, hiding behind the veil of decentralization in a DAO, and, like, for all intents and purposes, Uniswap is a protocol. It's one of these tools. It's a non-custodial way of interacting with these cryptocurrencies, and then more recently, the DAO had voted to enable what they're referring to as fee switch, so allowing token holders and the protocol itself to extract value from implementing fees for trades, and then potentially powering revenue fueled buybacks. And so when we talk about the Howey test, like, there maybe is some gray area here, but there was a lot of controversy in this discussion because I believe Amanda Fisher was also involved to some extent trying to push through FTX's power in maybe taking a foothold in the U.S. markets. But I wanted to hear your opinion on that one specifically, and how that, if you believe that Uniswap's fee switch is sort of setting a precedent for future protocols that claim to be decentralized, considering that a lot of tokens for Uniswap, token supply, I think, is held by A16Z and some other big institutions. So I'm not sure if there is like a sufficient level of decentralization there.
Yeah, I mean, there's a lot to unpack there. There are two securities law questions about Uniswap. One is the uni token a security under the Howey test, and there the fee switch, I think, is relevant, right? The Howey test asks, are you investing money in a common enterprise and the expectation of profit based on the managerial efforts of a particular group of people? Sharing protocol revenue with uni holders probably does create an expectation of profit. And then the question is it decentralized enough that you're reliant on the efforts of any particular group of people like A16Z or the Uniswap Foundation? Or is it decentralized enough that there's not a particular group, it's a decentralized community? I don't know. That's a difficult question. Then there's the tool service distinction that we're talking about, which is the Uniswap protocol a securities exchange, assuming that there's some tokens you can buy and sell that are securities, right, other than Uni. And there, I think the answer should be more clear that no, that's a tool because it's non-custodial. Just like it's not a bank, it's also not a brokerage. It's just a piece of software. I won't get too far into this, as she and I have had Twitter. I think Amanda Fisher is a bad actor. She was the former chief of staff of the SEC in the Gensler era. She's now basically at an anti-crypto think tank that takes money from the traditional finance industry. I wouldn't take what she says in good faith. Yeah.
I did not know that it was that bad. uh, yeah, we just wanted to pivot real quick too, because we see that like since the last time we spoke, and you're working with the Bitcoin Policy Institute. So wanted to ask you like what's going on there, because we haven't actually had a chance to speak to you about that, and it sounds very exciting.
Yeah, so in many ways, I would say BPI is sort of the opposite of what Amanda Fisher is doing at Better Market. We are trying to help policymakers, especially at the federal level, understand, what is Bitcoin, why is it important, why is it an important topic of policy consideration, right? As opposed to like think about Bitcoin the same way you think about meme coins, and then like what are the right policies to enact. So the sort of two biggest policy areas we focus on. One is we think that the United States adopting Bitcoin as a store of value at the government level is good for the United States and good for Bitcoin. We see the world moving away from sort of a unipolar world reserve currency in the form of U.S. treasuries. I think that started in a big way in 2022. I mean, there are two, like in 2022, by freezing Russia's FX reserves, we proved that treasuries are not neutral, right? We can just hit a button and freeze them, just like Tether can freeze USDT. And then we've also been debasing it, a lot in 2008, a lot more in 2020, and then again in 2021. And we're just going to keep doing that. And so it's not going to hold its value. And so we see countries diversifying their central bank reserves into other countries' fiat currencies, but also into hard assets like gold. Gold has probably been the biggest winner. And we think that Bitcoin will be a part of that mix. We're already starting to see that some countries adding it to their balance sheets. And we think that if the United States were to take a leadership role there, it would benefit hugely. First, like if we monetize Bitcoin and we hold a lot of Bitcoin, that's great for our balance sheet. We can help retire a lot of our debt. We're just going to make a lot of money on that trade. Also, if you look at sort of who owns Bitcoin versus who owns gold, our geopolitical adversaries like China and Russia have been stacking gold for heavily for a decade now. Bitcoin is disproportionately owned by American individuals and American companies. If we monetize Bitcoin to the detriment of gold, we basically cut the legs off our adversaries' monetary policy and enrich American firms and individuals. And just as a strategic play, that makes a ton of sense. So that's sort of the basics behind. There's both the sort of like immediate benefit and then the strategic benefit of the strategic Bitcoin reserve. We think stablecoins are also part of that story. We can export American values around the world. As an American, it's easy to take for granted that I have access to a U.S. bank account where I can hold dollars, and a brokerage account where I can, own equities, risk on assets in my retirement savings for long-term savings. Most places around the world, that's not possible, right? Like maybe you probably can't get access to a U.S. bank account. Maybe you can get access to physical U.S. cash, but in a lot of places that's dangerous because it's a black market. With stablecoins and Bitcoin, if you have any kind of smartphone, right, you can hold an arbitrary amount of risk-off savings in the form of stablecoins and risk-on savings in the form of Bitcoin. And that's an incredibly powerful sort of foreign policy tool that the United States, I think, is insufficiently leveraging. And so that's the type of thing we talk to the government about. The other big issue is, how to make the United States a leader in the industry. And there it comes back to like the biggest piece of that for me is this tool versus service distinction. We're never going to be the leader in Bitcoin anything if we throw software devs in jail for creating non-custodial tools. And so I'm very focused on that issue from a policy perspective as well.
And just going back to what you said about the, these dinosaur judges and, people legislating and regulating that have no idea, they don't know anything about this new technology. So how much of this uphill battle is just education? Like,
that's the biggest part. The biggest part of what we do, we go to the agencies, we go to Capitol Hill, we hold conferences, we have meetings with the White House, and we just, orange pill. We just explain this is how it works. Here's why it's important. Here's why it's good. And then the truth is, like, once people get that, the rest becomes a little bit easier. But education is the challenge. And it's really interesting now. We went from an administration that was more or less openly hostile to the industry to the number of, in the executive branch at least, the number of just open Bitcoiners is pretty astounding. And then we have more and more champions on Capitol Hill as well. People that have been there for a while, like Senator Lummis, but also, I'm really, we have this congressional fellows program where we're sending people to be full-time sort of Bitcoin focused staffers on Capitol Hill. And then the people we've been talking to, right, like Richie Torres, a Democratic congressman from New York City, is incredible on this issue. Really gets it, really gets the policy stuff, and the Overton window is really shifting. I think part of this is honestly, it's like the Bitcoin ETFs. I think changed the conversation a lot, but it's incredible to watch how much easier these conversations has become over the last year.
That's encouraging.
Yeah, absolutely. I think cryptocurrency and crypto people are like a very skeptical bunch, right? And I think you published a piece on Elizabeth Warren a little while back. Essentially, I'm not in so many words, but like kind of calling her a paid shill, trying to tank this industry, tank blockchain, Bitcoin, and cryptocurrency adoption. And you've laid out some incredible arguments, not only for, let's say, quality of life, remittance, and actual use cases behind this technology, but on a global stage, strategic reasoning, right? And I think a lot of people that might be listening in are still very, very curious to understand who are opponents of adopting this technology or using it in this way. And I think many people might guess, big banks or financial institutions that have something to lose. Maybe there are certain organizations or political camps that are still against this. Like, where are you seeing the most of the opposition come from? You don't have to name drop if you don't want to.
It's
We
two
encourage
places.
name dropping.
It's two places. I mean, specifically with stablecoins, it's the banking lobby, right? They see stablecoins as a place that like deposits will flee, and that's really bad for them. They maybe care a little bit less about Bitcoin, but they are pretty opposed to stablecoins. The biggest opponent, though, politically, is um, it tends to be more on the Democratic Party, but there are people on both parties who feel this way. It's people who think that there shouldn't be domains that the government doesn't have control over, right? The clearest name to drop here, because the clearest example is Elizabeth Warren. She doesn't like the idea that you can have a Swiss bank account in your pocket, which is what Bitcoin is, right? Like you can get really, really solid protections against debasement and confiscation by holding Bitcoin. That, in a lot of ways, Bitcoin in particular, but crypto more broadly, it should have a lot of bipartisan policy appeal, right? Even on the left, right? It's incredibly financially inclusive. It's fair. It doesn't treat rich people differently than poor people. It doesn't treat black people differently than white people. Anyone around the world can get access. It's permissionless. There are a lot of things that like Democrats should like about it. The one way where it's kind of not neutral is that it takes functions that were done by the state or by state regulated institutions, and it puts them back in the hands of the people, of the users of this technology. That's the cypherpunk sort of origin of Bitcoin and crypto, and that's the way it's not. So the most of the like political opposition comes from people whose worldview is you can't have these carve outs from government control. My view is that's a pretty un-American attitude. Those people don't believe in the like founding principles of our Constitution. We are a country that is all about individual liberty, and like those are the main opponents here.
Yeah, it's a damn shame. I hope it becomes less partisan. Like I'm tired of. It's such a easy. It's such an easy W. Like just get on board with it. But yeah, it's becoming more divisive sometimes. There seems like at least. But we got to wrap up soon. But I really wanted to ask you this because we have a lot of founders in our community that watch this show, and like I said, we did this with the like a cybersecurity expert. But what would be your best advice from day one for founders? Regarding like the setup of a company. It doesn't have to be anything like actual legal advice, but like you said, you're happy to give this from your point of view, and I think people would really value that feedback or that advice.
Yeah, I'll try and we just have a couple minutes left, so I'll try and speed run this.
Yeah.
Look, this first thing I'm going to say is going to sound self-serving, but it's absolutely true. Get a lawyer involved as early as possible. I promise you everything will be easier and cheaper if you do that early. The like bills that we send to clients that get involved, ideally pre-incorporation, tend to be way smaller than the cost for clients who like tried to do their own thing on Stripe Atlas and did everything wrong and come to us and we have to fix it. Like that's just, there are some things you can't fix, and the things you can fix tend to be expensive. So get a lawyer involved early, especially before you raise money. Like really, you want to do it before incorporation, but like it's very hard once you've accepted terms from a pre-seed VC without a lawyer. And like I promise you that they have done this more times than you, and they will look for ways to screw you. So get a lawyer is number one. Number two, we talked about this a little bit before. Be very, very careful with what percentage of your token supply you're allocating to the team and to investors. We saw, I think, especially in the token launches in 2023 and 2024, where tokens are staying private for more rounds before TGE. And then you launch a multi-billion-dollar valuation and half of the tokens belong to insiders. That's just guaranteed failure. So you need to be very protective of your tokenomics. If you're listening to this podcast, this is probably something you're aware of, and you guys are probably great to consult with on that also. There's, I get a lot of people asking if they should incorporate somewhere other than Delaware. No, like unless you're Elon Musk and you have a specific beef with the Delaware Chancery Court, Delaware is still the best place to incorporate a company. It has the most robust set of case law protecting property rights. And you may or may not want an offshore. Like not everyone needs an offshore, but even if you're doing an offshore, generally, if you're taking investors' money, they want to see a Delaware C Corp as part of the mix. I think that's really important. What else? Generally, whatever you're building, if you can make it non-custodial, that will make your compliance overhead way lower. It's really painful and expensive to get money transmitter licenses in 50 states. Now, calling yourself non-custodial and being non-custodial are different things. So again, that goes back to sort of piece of advice number one: get a lawyer who knows what they're talking about to sort of look at your tech stack, ideally before it's built, and be like, yeah, like we think this does not make you a money transmitter. That's incredibly important. And yeah, like build in the United States. Like now's a good time to build in the United States. The threat, for people launching tokens is less coming from the SEC than it used to. It will come more from plaintiffs' lawyers, right? People who are going to do private lawsuits against you to make money, claiming the same Howey test argument. And so you do need to be careful about your compliance strategy. But like now's a great time to build.
Have you seen, by the way, like a big uptick or like a lot more companies?
Yeah.
Like more companies are domiciling in the US because they trust.
Oh, yes. Yeah. Oh, I thought you meant the plaintiff lawsuit. Yes. Look, most companies have a labs co in the U.S. even in the before times, but there are many more companies that are sticking with the U.S. and they're launching the token out of the U.S. entity, and I think that is broadly speaking appropriate and a good thing.
Awesome. I did not know that.
That's some fantastic advice. I mean, that's a lot of like hardline advice as well. We expect nothing less, honestly. So I think many founders listening in are going to find that very valuable. Zack, I want to thank you so much. Before we sign off, we've got one last question. We start and end every interview in the same fashion. And so I'm going to ask you this question. There's a simple rule around it, right? I think for you, it's going to be just one thing. What are you most bullish on in the next, let's say, 12 months within this industry? It could be a person, place, thing, asset, whatever. The only thing you cannot say is you or your own law firm. And in this case, let's say Bitcoin Policy Institute as well.
Okay. If I'm being broad, Bitcoin, I think, is still structurally undervalued. Like it's changing what money is in specific. And I'll give the disclaimer that they are a client. I'm also a venture investor in this company, and I'm friends with the founders. So I'm very biased. But of all the companies I work with, one of them I'm really, really excited about is this company called Anchor Watch that is doing cold storage insurance. And I think they've just created the best custody stack. Not only that exists, but like pretty close to the best one I can imagine.
Interesting. Got to check that one out.
Yeah, check them out.
Yeah. Well, Zack, thank you so much for coming on. It's been an absolute pleasure getting to speak with you for the past hour on the Boom Room. We've got to have you back on because I think we've got maybe like 12 more questions that we haven't asked.
Just 12?
But it's so many. But yeah, it's been very enlightening. Again, Thanks so much. And yeah, to all of our viewers out there, make sure you tap that like button and throw us a follow if this content interests you. We've got plenty more Boom Room interviews coming out. And if you're interested in Zack, Rain's Law, or the Bitcoin Policy Institute, make sure you check out the show notes. We're going to drop some links below. Zack, thank you so much, man.
Thanks so much, guys.
Enjoy the rest of your day. Take care, guys.
Take it easy,
Take
Zach.
care, y'all.